when the moving averages are condensed really tight, like how Apple is condensed, you often will, when you see those moving averages break really easily, whether it's on big volume or not, you get this big fat candle that goes through all of them. It almost always will fail at some point that same day. And by fail, you can still have a successful trade, like buying it open or buying right when it crosses that purple moving average, which is my 200 SMA. But the failure is going to likely be just as hard as the initial breakthrough, because it's going to want to get pulled back to consolidate a little bit around those moving averages before it actually has the sustained breakout. So basically what I'm looking for when I'm playing this, like this morning I posted on Twitter, you can see the break at open, it goes up, it breaks 150. Everybody in the world's like, yay, Apple broke 150, finally, great, cool. Except it rejected pretty goddamn fast. So it dipped back down when it started to show weakness on that first that first green candle at the top with the spinning top candle, the big wick on the top, the big wick on the bottom. I waited until the next wick or the next candle broke below that wick for me. This strat doesn't necessarily you don't necessarily have to do this, play it the way I did for this strat, but it's just one of those like improv things where you can like scalp the opposite direction because you know it's going to pull back down to those MAs. So I bought puts and I ran it down, and you can see it went back down. It tried to consolidate a little bit around those moving averages, and right in this area. And then it failed again, and it dipped back down almost as much as it shot back up. But what the key to this strat is when you see it moves back up, you can see these smaller candles, and you can kind of see it's consolidating around them. It breaks through here. You get these couple of candles where it basically comes back down. It's like a little flag almost. Comes back down, tests that MA 200, and then the next candle finally breaks the upper wick of the candles that closed over the 200 MA. So basically what you're looking for is a candle close on the 5 minute over the MA that is on top. It can be any of the three. You have a question? No, your mic's just going nuts. Okay. So once that candle wick is broken right around here, on this big-ish green candle, that's where I entered. You can see that in this particular trade, it went red very, very briefly. In the next candle, I think at the peak, I was down like 5%. It was very little. And then you can see it finally breaks free from that range, and it just basically runs all day long. And I just kept moving. I took some profits along the way, and then you just keep moving your stop up, and you get this strat just generally gets really big, long, multi-hour breakouts. So one of the other ones that was simple that somebody talked about was PayPal. Again, very simple, but the breakdown wasn't quite as successful if you were to have played puts as it was with Apple. You can see again, the moving averages are super tight on top of each other. It opened up way down here. Oh wait, my stream went away. My bad. So the moving averages really tight, big candles, and followed by this rejection. Again, you see this big spinning top up here, and then you could play the puts back down. Generally, when I do that, I kind of am just looking for a retest in the grouping of moving averages. Apple happened to be really, really good today because it actually broke below them. It's not always the case. This is more of what you would see in this type of situation. So then you can see it basically is kind of consolidating up, down, above, and below this grouping of moving averages. Then you get this biggish candle here, but you can see I don't know if you can see it great, but you can see on my my volume at the bottom, it's almost entirely buy volume when it finally does break that MA 200. So in that case, you can go ahead and buy, or you can wait for that candle to close and then get the upper wick. As you can see, there's, even if you get in these kinds of trades a little bit late, there's still plenty more that you can get out of them. So if you miss it by one candle, usually you're all right. And then you can run it up, and it just runs up all day. And then in this particular instance, it just kind of was flat the rest of the day, kind of up, down, up, down, up, down. Facebook, again, very, very similar to Apple today. But what you're looking for is this consolidation along all three of these moving averages, where you get the up and the down, and sometimes it's a lot less violent. Ideally, you'd like to get some consolidation, in the first 15, 20 minutes before it breaks out. But oftentimes with opening volume, you get this big shoot through, and then this big rejection, and then some consolidation, and then you get the run once you get over that top moving average. Is there a workaround for people who like less lines on their chart? As far as moving average lines, or as far as the levels that I have drawn on my charts? And does the candle have to break through all MAs to confirm your method? Yes, it has to confirm. It has to break through all three of them. You can see I have a pink one on there too. That's one I added recently. That's the MA 400. Doesn't really play a role in this strat. It's something that I have there because it's basically the same as the 10-minute 200. So a lot of times you'll see a little bit of resistance when it does finally break through these or break below these, and there'll be a little bit of resistance at that level, so that's why I have it there. Not necessarily for this strat. But as far as having less lines on their charts, Karma, unfortunately, technically, you could probably get away with just the 50 and the 200, but I haven't really tested it. I use all three. A lot of times you can see the way that the price moves through the moving averages, and the 100 is, in the way that I see it in my brain, the 100 is part of that. But you can feel free to, back test it and look at it with just the 500, or the 50 and the 200, and let me know. I would love to know if you found anything. So let me go look at one of the tickers that didn't trigger the way that I wanted it to today, that I was watching. Let's see here. So I was watching Etsy today because the moving averages were getting close. It wasn't necessarily that I expected it to trigger as much as I wanted to keep a really close eye on it because it could trigger towards the end of the day. So this is Etsy for today. So you can see kind of why I have it on high watch for tomorrow. We got all three moving averages stacked right on top of each other, really, really flat coming into close. Very similar to how Facebook and Apple were going into today. But you can see at open, you got the 200 up here, you got the 100 and the 50 kind of on top of each other here. And you can see as the price action does what it does, you get a lot of rejections at the 200. You get some rejections more so later in the day, where you can kind of see as the moving averages are condensing down on top of each other, it's kind of like pulling in the price in that general area. So the tighter and tighter and tighter they get, the more explosive the move when they finally, when the price finally clears all three of those tickers. Does that make sense? So that's basically the gist. It's that simple. And it doesn't necessarily have to be just for calls. It can be for puts also. The rejection, like for example, with Etsy, let's say tomorrow, right now the price is underneath those moving averages. Let's say tomorrow at open, the price shoots up to, 190, high 191, 192, somewhere near today's high of the day, right? And then it rejects back down. If it rejects back down, it doesn't necessarily mean that we want to play puts immediately. We want to wait and see whether we get any kind of consolidation on smaller candles before the direction is chosen. And then once we get that price dips below the bottom moving average. So let's just say that for the sake of tomorrow, this is exactly how the moving averages are still at when the price breaks down. So we get a candle close under this red moving average, which is my 100. And then when the following candle breaks the lower wick,